most traditional IPOs, companies raise money. So they issue new shares. They might go out and raise $1 billion, and they hire investment bankers to go and sell that stock for them. Spotify is not issuing any new shares, and I actually think that it signals a lot of strength by the company and management, where they've decided, hey, they don't need to raise more money, they don't need to issue new shares and dilute existing shareholders, and so what they're going to do is just list the existing shares on their capitalization table, and shareholders will be able to sell on day one. So our understanding is there isn't going to be a lockup, and that shareholders will be able to sell their shares to new investors on day one without any new shares being created.
So when we see it first trade, how should we think about the price, given that there won't be a lockup? One of the reasons there isn't usually, or there is a lockup, is to kind of hold the line on the price.
Right. Yeah. So in the months leading up to this listing, Spotify's secondary market's been pretty active. So we've been seeing a number of share trades happening, in the $22 billion range. And so we think that's going to be a proxy for where share trades might begin. And then obviously, given how a lot of these tech IPOs perform, we think it's going to trade meaningfully above that, on the first day.
And is your expectation that if this is a successful approach, that we're going to see the Ubers of the world, the Lyfts of the world, the Airbnbs of the world follow suit in a similar fashion?
Yeah, I'm not sure. I mean, it's very unique to Spotify. So the fact that they're a consumer brand, that it's an easy to understand business model. I mean, it's very similar to Netflix. It's subscription, it's pay per month. I mean, people have seen it before. And the fact that they don't need money, right? They've got a strong balance sheet, more than $1.5 billion of cash in their balance sheet, and the business is free cash flow positive. I think that for this specific case, Spotify doesn't need to go and raise new money. In the case of yeah, go ahead.
No, go ahead. I was going to just say, as an early investor in this company, are you happy that they're approaching it this way? Does it make it better or worse for you?
Well, we're going to own more of the business, right? So typically we take 10 or 15% dilution in an IPO. So we'll own more effectively without, taking that additional cash in. For the case of Airbnb or Uber, I mean, it just depends on what their needs are. If they need to raise more money, strengthen their balance sheet. I mean, if Uber wants to go buy billions of dollars of autonomous cars, they're going to need to raise money in an IPO. But if they don't need to do that, then maybe they pursue a direct listing and just put the shares out there.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.